Okay, thank you everyone for coming. Today we have the luck to have Dan Awrey, who is an expert in finance, but particularly on something that is really going on in Chile, which is that new technologies create new forms of payments. Now every one of us has received some email offering some app that will give us some kind of discount in some gas station, for example, and to enroll in their financial application. And also some suggestion of some kind of benefit if we put our wages that the company pays the wages into the app. So that's exactly what Dan works, is the interaction of technology and how things have changed and how we should regulate it or not, maybe, I don't know. So he will talk to us about the book Beyond Banks, Technology Regulation and the Future of Money. Very, very interesting conversation for Chile. And we have also the privilege to have Kevin Cowan, who was the vice president of the Comisión de Mercado Financiero, who regulates a lot of these things. I cannot think of someone better in Chile to discuss this, and that's it. So Dan will present us for less than 30 minutes. Then Kevin has some presentation about his comments of the book. Who else better, given his experience in regulation and policy making in this area? And then I can open the floor. You will be able to write me questions or even raise your hand if you want to talk directly. That's it. Thank you, Dan, for being with us.
Thank you so much, Bernardo, for inviting me. And thank you to Kevin for taking the time to read the book and to participate in this discussion. Thanks to everybody else for coming. I hope to keep my remarks as brief as possible so that we can have a conversation about what's going on around the world, but also what's happening in Chile. I'm going to assume that most of you have not read the book, which is probably for the best, given this talk. There's lots of different ways, angles that you can come at this subject from. And the book comes at them from a number of different angles, from a historical perspective, from a monetary and financial regulation perspective. But the perspective I've decided to take, at least for the purpose of today's talk, is something that comes up over and over again when I talk about the book and when I talk about these issues with policymakers. And that's sort of my view of the relationship between financial sector competition and financial sector stability. And so I want to basically today present to you what I think is the classic view of the trade-off between competition and stability, especially in the realm of money and payments. And then the alternative view of the world that I sort of espouse, sometimes implicitly in the book. So the classic view is that competition and stability at the margin come into conflict with one another. At the heart of this view is the idea that money is a product of financial intermediation, and specifically of bank-like institutions that borrow short and lend long, and that the borrowing short, or at least part of that borrowing short, takes the form of demand deposits that then circulate as a type of money. In this world, as I'll talk about more in a moment, once you start creating competition for money between bank-like institutions or between banks and non-banks, you also raise the prospect of increasing the price of money, and that increase in price then feeds into changes in the balance sheet risks of the institutions that create money. So if you create competition on the liability side of a bank balance sheet, you are potentially creating or inducing greater risk levels on the asset side of their balance sheet. In this traditional story, payments do not really have a role. Financial institutions compete with one another over effectively the price of money. That is the interest rate on deposits or deposit-like balances. My view of the world is somewhat different, probably close to inverting this. In my world, I'm not interested in money as much as I am in payments, which are not a function of financial intermediation per se. The fact that they've become bundled with financial intermediation is something of a historical accident, but rather the product of technology. And that competitive payment markets, for reasons I'll talk about, actually drive financial stability as opposed to instability. most importantly through heterogeneous business models that do not have the same type of leverage that banks do. And lastly, that money ultimately is something that the private sector has very little to compete on relative to the public sector. That is to say that we may use private sector money, deposits, M1, M2 most of the time when we're making payments. But we all know deep in our heart of hearts that M0 central bank money, at least in terms of money, if not necessarily payments, is the best we can possibly achieve. Not only because it comes from institutions who do not face bankruptcy risk and in many jurisdictions do not face liquidity risk, but also because, and we were joking around about this a little bit prior to the call, if you've got a world where your public money, your M0 starts to default, you have much bigger problems than financial and monetary stability, and certainly bigger problems than the level of competition within the payment space. So that's just a brief overview. I want to then just sort of build on this a little bit and talk about my plan that sort of comes out of this, or blueprint that comes out of this sort of alternative view of competition and stability. But first, I want to go into a little bit more detail about the conventional view. I'm sure a lot of you have seen a version of this chart in your lives. For those of us that grew up in the world of banking, this is sort of what your grand banker tells you when you sit on their knee when you're 4 years old, that basically the business of banking is a carry trade. I borrow at short-term interest rates, I lend at longer-term interest rates, and I capture the spread in between the two. This is the essence of the carry trade. Back when I was a young banker, we used to talk about 3-6-3 banking. You borrow at 3, lend at 6, and then you're on the golf course by 3 p.m. This view is the starting point for the classically understood trade-off between competition and stability. Specifically, if we increase my borrowing costs, because I have to, as a bank, deliver higher interest rates in order to attract deposits, that has to go somewhere. It can either go into a compression of the carry trade, making banks less profitable, or it can go and transmit onto the asset side of my balance sheet, where in order to maintain the same spread, the same carry trade that I had before, I'm going to have to increase the volatility, the riskiness of the assets that I hold. The conclusion then of the conventional story is that if I'm competing for deposits and having to invest in more risky assets to maintain the same spread on my carry trade, is that this is something of a ticking time bomb. Is that eventually one or two things are going to break, either my funding model or my risky assets, if not both, and spread out across an entire banking system. These type of strategies then mean that that competition that started on the money market side, on the liability side of my balance sheet, and ended with the failure of a bank or the correlated distress within the banking system are connected causally. And therefore, we want to protect banks, at least to some extent, from the destabilizing effects of competition. Now, this is a just so story in many ways. It is not necessarily true in all states of the world. It depends on the structure and level of competition within your banking system. It depends on things like your deposit betas and how sticky your deposit base are. And it depends on the range of investments that you can possibly make as a bank, both as a legal matter. Many jurisdictions limit the type of investments that banks can make, but also from an opportunity perspective in terms of the type of projects that need to be funded in the economy and the riskiness of those projects. But as a general matter, this basic intuition is something that is quite embedded in a lot of the intellectual frameworks governing both monetary policy and banking regulation. And there's something that I honestly come up against all the time in my own work, and especially as I've presented this book. And so that's why I want to start with this, because I felt like I've spent most of the last year in talking to people about the book. This is the thing that I get the most pushback about. And so I want to talk about then about what my pushback is to this conventional story. the first step in understanding my pushback is that this conventional story is premised on the idea that money is a product of financial intermediation, that banks are where the money is, and banks are inherently levered institutions that engage in credit, liquidity, and maturity transformation. Again, that is true in a lot of jurisdictions, probably almost all jurisdictions, to be honest, but it is itself not set in stone. There was a world before banks. There will probably be a world in which banks, I doubt banks will ever disappear, but there's a world in which they become less important parts of the overall monetary system, and that's ultimately what the book explores. The second building block then is that there's a tendency in the classic competition versus stability trade-off story to, at the very least, downplay the role of payments, and in most cases actually just to eliminate them from the conversation entirely. That when we talk about competition for money, we're talking about competition over the interest rate on holding positive balances in bank accounts. And we're not talking about the whizzy and convenient and fast and secure and other sort of features that consumers have come to expect out of their payments. That is to say that when it comes to the choices that consumers make about how it is they make payments, we tend to leave the primary sort of factors out of the equation, and that's the technological element of modern electronic payments, and that's the second part of the story. My book ultimately is designed to foreground those elements. The next book in this series, should I be able to deliver that before I collapse in exhaustion, is actually a more empirical look at the way that human beings are wired when they make payment choices. Part of that may be about the type of money that they're holding, but a lot of it is about what is the most convenient payment method in a given circumstance. And that's not about interest rates. That's not about financial intermediation. That is increasingly about the technological platforms from which payments are made. All of which is saying that there's effectively two markets here that we tend to think of one. One is for the monetary instrument itself. The other one is for the way that the monetary value is transferred within a network and ultimately in the broader economy. And the payoff from all of this is that once we break these things into two, it becomes pretty obvious that the policy levers that you would pull in order to make good money or good payments are different from one another. For good money, it's all about laws and institutions. If you think about things like deposit insurance, if you think about things like the discount window and lender of last resort arrangements and the bankruptcy frameworks that we have for banks, these are all designed to make banks warehouses of good money. But when you look at the things that make for good payments, it's actually largely a function of the technological choices we make, and over the longer term, the type of governance arrangements that we have about deciding between our technological futures and the type of experiments that we are willing as a society to undertake in order to make a better payment system. Now, I can lay this out for you in a little bit more detail here. Not only are the drivers different between good money and good payments, but once we break them out, it becomes painfully clear that actually the way we measure success in money and payments is also very different. In money, we care about whether our money has a stable nominal value, not real value. We care deeply about the real value of our money as well, obviously. That is a different set of policy questions, though, around things like monetary policy, exchange rates, and the like. And two, we want it to be used as a widely accepted means of payment. We don't value money that nobody else accepts as money. That's almost tautological. But when it comes to good payments, we actually care about a whole host of entirely different things. We care about cost, speed, security, privacy. We care about convenience. We care about accessibility. That is the ease with which we can actually access payment rails. One of the things that has sort of happened in many jurisdictions, the US included, on this front, is that the conversation about the level of the banked population and basic access to financial services has shifted from being about whether you have a bank account to whether you have a smartphone. And this is the type of dynamic that I'm talking about here when I talk about accessibility. historically, we have not thought in technological terms about these issues, but as technology becomes more fundamental to our systems of money and payments, the ability to access the technology through which we make payments becomes a big part of this story. And then lastly, and this is the part where you guys can guide me a little later on, as a lawyer who's also a technologist who started his world in tech before shifting to finance and then law, is that I care a lot about interoperability. In a world where it was just banks making payments to other banks, interoperability was not a particular big deal, especially if they were settling through central bank reserve accounts and through a single clearinghouse that was sending sort of standardized messages to the entire collection of financial institutions that were a part of the payment network. But what we're in the beginning of now, and in some jurisdictions in the middle of, is this Cambrian explosion of different types of payment platforms, different types of networks. And in that world, the ability of these networks to speak to each other and therefore to send payment instructions to one another ultimately matters a great deal in terms of the type of economies of scale and network effects that we associate with not only good payments, but also good money in terms of things being accepted as a widely accepted means of payment. So that's my starting point here. Money and payments are two different things. The argument that I'm ultimately going to make, or at least the meta argument that I make in the book, is that governments are really good at using law and institutions to create good money, especially in bad states of the world where we've known from time immemorial that the things we accept as money in periods of illiquidity and crisis tend to have a hierarchy to them. And we would prefer to hold public money rather than private money in those states of the world. At the same time, the government does not necessarily have a comparative advantage in the type of technological choices that come with creating good payments. Now, there's a thin story and a thick story as it applies to this particular element of my argument. The thin story is that many governments aren't particularly technology-forward institutions. I live in the United States and I'm Canadian. Those are two good examples of countries where the public sector sucks at technology. But it is not universally true. You look at some of the countries that I look at in the book where you've got PIX in Brazil, you've got UPI in India, where the public sector has actually played a pretty constructive role in designing the technological network architecture at the heart of their payment systems. And that's why it's the thin story. It really depends on specific institutional and cultural factors that vary across jurisdictions. The thick story for why states are not good at technology is actually that, politically speaking, they can only conduct one experiment at a time. Brazil has PIX, the United States has FedNow, India has UPI. But the private sector can actually engage in a whole bunch of experiments simultaneously and see which ones stick in the marketplace. Now, if you're of the traditional view that there's a trade-off between competition and stability, that sounds terrible, right? More competition will foment instability within the financial system, which then, to me, leads to the conclusion that the starting point for being able to promote competition in payments is making sure that the monetary side of the equation is stable. That is, making sure that whatever institutional box you put the monetary instruments into is one that guarantees that it maintains a stable nominal value and therefore is something that people are willing to use as a means of payment. That's the basic intuition behind the argument. The basic question is then, well, how do you do it? How might you go about creating a level playing field in monetary terms that then enables competition to play out over the technological components of next generation payment systems? And so taking this as my starting point and taking my distinction between good money and good payments as sort of the basic intellectual frame, the book lays out a plan for doing this. I always feel somewhat sheepish doing this outside of the United States, Canada, places like that, because especially on the good money side, effectively, a lot of jurisdictions have already done this. They have created payment charters, that is charters for non-bank payment platforms e-money institutions in the in the European Union, payment services providers in many other jurisdictions, that give them a regulated status in effect. I would then combine that, and I'm at an event in New York City today where we've been yelling and screaming at each other about this all day, where I would combine this with a prohibition against financial intermediation. These would not be levered institutions in any way. In fact, as I'll talk about in a moment, I would have them stick all of their customer funds in a ring-fenced central bank reserve account, making the money default free, eliminating a lot of the issues that otherwise arise as a result of the shadow of bankruptcy for these non-bank institutions. Now, there's a lot of trade-offs there, and I'm happy to talk about them in the Q&A. I spent the morning getting beaten up to a certain extent over this issue. The United States, most other jurisdictions, when they do create these charters, contemplate that they can invest in things like government debt securities and other high-quality liquid assets. But there are important, if very complex, trade-offs associated with each of these potential models. The next thing I would do, having created a charter for these institutions, having effectively made this charter something that doesn't involve financial intermediation, is to make sure that these institutions are not so complicated that their failure could potentially lead to the erosion in the economic value of the monetary claims that they make. And the way that I would do this is effectively saying that the monetary claims are the only claims you can make, the only debts that these institutions, these firms are able to undertake. Now, that's not to say that the wider corporate groups within which they exist couldn't do other things and take on debt in different ways. But effectively, at the institutional level, at the firm level, the corporation level, I would prevent them from really borrowing money, lending money to their affiliates or any other parties, or undertaking activities other than the provision of payments, in effect. And lastly, as a backstop, a lot of the book is dedicated to exploring exactly how bad bankruptcy is for money. I don't know how many bankruptcy folks are on this call at the moment, but bankruptcy is inherently antithetical to the idea that something is going to maintain a stable nominal value. Once the automatic stay in bankruptcy applies, people can no longer use the liabilities that they call money until the bankruptcy process is concluded or they've applied to have the stay lifted successfully. From there, most monetary IOUs in non-bank financial institutions are unsecured claims, and those unsecured claims are the first to take a hit in bankruptcy in the event that we need to restructure the balance sheet of the failed institution. To eliminate all of that, I would propose instituting a process that is not unlike a very simplified version of the non-bankruptcy resolution frameworks we currently use for banks. All the money in my model would be sitting in a non-defaultable central bank reserve account. It would really just be an administrative process of returning money to customers as quickly as possible, in effect. But all of this really is just the prelude. All of this is just designed to create good money that behaves in the same way that an insured bank deposit would. But the real heart of my story is on the other side, the policy blueprint around good payments. And here, I think, a lot of jurisdictions have already done good work here, but there's a lot left to be done almost everywhere in the world. And the starting point for that is a lot of jurisdictions, although I'm just hearing about some of the things happening in Chile today, is that banks tend to be the institutions that have access to the core central bank settlement rails, and therefore are also the institutions at the heart of as owners, custodians, participants of any clearinghouses that process electronic payments. So I would open that up with effectively what we would call in the railroad industry a common carrier rule, what I'm calling an open access rule that effectively says that if you have a payments charter and you comply with all the good money rules that I sort of lay out, you should have access to both central bank reserve accounts and also financial market utilities, clearinghouses, and the like. And that should be something that should be non-discriminatory. In many jurisdictions, these FMUs are owned by incumbent banks. And there is a tendency, the temptation there to engage in anti-competitive conduct. And my open access rule would be something that would make that type of conduct illegal, and something that could be enforced by the authorities. The second thing I would do, and admittedly, this is the hardest thing, really the hardest thing. I've spent 7 or 8 years trying to design an optimal interoperability rule. As we move towards this more heterogeneous world, one of the things we're going to have to do is make sure that different types of payment platforms can send and receive payment instructions to each other, and that ultimately they can then reconcile those payment instructions for the purpose of sending instructions to the central bank to actually cross the payment. That is settlement. That is easier said than done in many respects. And it's especially hard in a world where the technology of clearing and settlement is changing. Because at any given moment, we will have made tons of investment in the infrastructure of our payment systems. But then at unpredictable moments, new technology comes along, new players come along, and over the longer term, it may make sense to invest in bringing them within these systems. But that requires investments in technological development that then you've got 2 questions about. Which investments should we make? What new technologies are worth investing in? And 2, who should pay for those investments? And that's the part where saying that we should have interoperability rules starts very easy and ends very complex. On the one hand, you would think to yourself that the new entrants should have to pay the costs of making old platforms interoperable with new platforms because they're the ones who are seeking to use the technology. On the other hand, that's quite obviously an economic barrier to entry for any new firm, which could slow down technological adoption of more efficient technologies. The problem is how to answer that question, what sort of rules to make around the allocation of costs and things like that. And that's ultimately where I come to my last big policy proposal, which is that you can't write rules for that. But what you can do is have a governance structure that has the right collection of decision makers in both the public and private sector, and integrating the views of the community at large around what they think the payment system is for, and whether they think these new technologies are worth investing in, whether they think the existing technologies provide the level of good payments in effect that we want them to, and whether we are willing to give away a marginal unit of good money for good payments. This is something that actually most jurisdictions are farthest away from. For a long time, the default was that central banks were responsible for making policy decisions about payment systems because they're the ultimate overseers of final settlement. The problem, of course, is that most central banks also have as job number 1 monetary stability. And at best, payment system efficiency is job number 17. And in the vast majority of jurisdictions, there's no formal payment sector development mandate that central banks have. And as a result, with only one stakeholder really being able to hold the reins, it's not surprising that then issues around making payment systems better, more efficient, less costly, more secure, more accessible are things that often have not been at the top of the agenda for policymakers. I still consider it kind of a miracle that in countries like Brazil, in Australia, Singapore, that payment system issues and issues of payment system efficiency and technological development have actually made it relatively high up in the policy agenda. And that's something that I think, my surprise at least, is a function of the fact that the only people who have traditionally cared have been central bankers, and they've had other, what they perceive as conflicting agendas to deal with, leading to sort of torpor, atrophy in this space. Put these 2 things together, and there's a clear story. On the left-hand side, the blueprint basically says, let's separate out the provision of money from financial intermediation. And on the right-hand side, it says, let's understand that payments is largely a function of technology, and let's regulate that system like we do other technological networks. everything that I have taken in terms of policy blueprints exists elsewhere. Open access rules have existed since the age of the railroad. Interoperability rules are used across networks from energy through to telecommunications. And multi-stakeholder governance models are something that are used across the world for other types of quasi-public or public infrastructure, especially network infrastructure. So all I'm really doing is acknowledging that money doesn't have to come from intermediation, and that payments are largely a function of technology, and following both of those logics through to what I think are their policy conclusions. All right, I'll conclude then just with a few things about what I think the benefits are of these proposals. I'm going to focus specifically on the competitive benefits, but I'm happy to talk about others and on what I'm not saying. Because unfortunately, I've received some very lovely reviews of my book from people who are very supportive of the idea that I'm not espousing, which is going away from banks entirely and moving to money that is not intermediated as the only money in the economy. So in terms of potential benefits here, the first thing that I want to point out, and this is how I got into this line of work about 10 years ago, is that as we've seen in lots of jurisdictions with the rise of PayPal, Venmo, various non-bank platforms, is that people use them as money, they understand them as money, but when things go sideways and these institutions go bankrupt, is that their holdings with these non-bank institutions do not behave like an insured bank deposit. They behave like an unsecured liability in a bankrupt commercial firm, and those two things are very different. My proposal at its heart for good money would eliminate that problem, thereby yielding much more similar outcomes for consumers in the event of bankruptcy of non-bank financial institutions, as many already enjoy with respect to insured deposits. The result of this is also then a level playing field in terms of good money. And that's the best you can really hope for, is a level playing field, because here the competition, in my view, is not going to take place in who has the best money, but who has the best payments. And if the money is equal across the board, and if the users of that money are always going to get their money back and never be subject to bankruptcy, these competitive experiments in payments can actually take place without having to worry about the impact of that competition on the stability of the monetary instruments underlying these experiments. One of the bigger picture results of this from a systemic risk perspective, and this is a big issue in the United States after the wake of the failure of Silicon Valley Bank in 2023, is that it then shifts away from the banking system responsibility for holding the deposits of all the non-bank intermediaries that I'm talking about. So in the case of Silicon Valley Bank, the stablecoin issuer Circle, for example, held about $3.3 billion in customer funds in an uninsured account with SVB. The very predictable thing happened when SVB failed. Circle's stablecoin, which is supposed to maintain a stable peg against the dollar, fell by about 17% in 24 hours. It stopped serving whatever stable nominal value purpose it would, not because Circle itself was in trouble, and not because its stablecoin was designed problematically, but because in order to access the payment system, it had to go through a bank, and it happened to have chosen Silicon Valley Bank. If I can take the Circles of the world, the Venmos and PayPals of the world, and not force them to hold customer deposits in bank accounts so they could get indirect access to the payment system, I've effectively eliminated a source of cross-sectoral systemic risk. I've eliminated the Circle problem because Circle would have an account at the Federal Reserve and not be exposed to the failure of Silicon Valley Bank. One of the things that this then leads to, because if you're a Circle, you're probably going to want to hold as many deposits as possible at banks that you are convinced are not going to fail. If I take away that incentive, I'm also then limiting the moral hazard problems associated with the too big to fail problem. If you look at the statements that were made after the 2008 financial crisis about why many banks were bailed out, the first words out of finance ministers' mouths often had to do with ensuring the stability of the payment system and the ability of the economy to run. well, what if banks were not the only place I could go to hold money and make payments? A more heterogeneous, diversified financial ecosystem for money and payments is something that reduces the too big to fail problem, along with the competitive distortions that come along with it. Lastly, and some people care about this more than others, is that a little bit of competition can also often be helpful in achieving public policy objectives, especially when incumbents have a ring-fenced business that leads them to underinvest in certain public goods, like the provision of fast, safe, and secure payments. The only thing I'll note here beyond these issues, and then there are trade-offs that I'm happy to talk about, is that a lot of these things do actually come down to competition. That I can achieve a more competitive equilibrium in the payment space. But since I have leveled the playing field for money, it's not clear to me that there's necessarily a trade-off in terms of financial stability, as is sort of postulated under the traditional model. Now, there is a big caveat to this. And the caveat is, well, what if I disintermediate banks? And I'm happy to talk about that because I think in some jurisdictions that is absolutely a live issue. It's certainly not anything that anybody can discount. Banks play important roles through intermediation, and because they connect money and intermediation, they're a key lever of monetary policy implementation. And there really is no denying that. But what there's also no denying is that in many jurisdictions, banks are becoming less important as intermediators within the economy. In the United States, for example, if we think of the two politically most important types of financial intermediation, home mortgages and small business loans, banks are no longer the primary intermediaries responsible for allocating capital in those two markets. And in that world, the possibility for intermediation as a result of these type of proposals is something that is less problematic than it might be in a purely bank-based economy. The other thing I would point out in this regard is that this is happening regardless of whether we have the regulatory framework or not. If you look at the increase in the global stock of stablecoins, for example, this has happened. We've gone from $2 billion to $200 billion in less than a decade. This has all happened despite the absence of good regulatory frameworks for most of this period. And part of this is why I'm writing the second book. Why does that happen? Why, when some of these institutions are clearly bad money, do we see consumers flocking to them in droves? And the answer, of course, is good payments. Is that people are generally going to prefer, and there's lots of psychological models that I hope to test to see which ones stick in this regard. There's lots of psychological models, from hyperbolic discounting to salience to all sort of things, that suggest that people are going to, if you give them something cheap and convenient, they're going to use it. Regardless of whether over the longer term that might be fomenting potential microprudential or macroprudential instability. All right, last but not least here, things I'm not arguing. The first one I mentioned earlier, I got a great write-up from William Boutier in Project Syndicate a couple of weeks ago, where he absolutely loved my idea of shifting all the money away from banks and towards narrow banks. And that is unequivocally not what the book is saying. I think banks, I have spent my entire career studying banks. I love banks. I think banks will, at least in my lifetime, continue to play incredibly important roles in the monetary system, in the real economy, and in risk management. What I am saying, though, is that, one, they've got competitors now, and the question is whether we want to level that competitive playing field and reduce the distortions associated with the current lack of level playing field. And then two, a little competition for banks, especially in the realm of payments in lots of jurisdictions, might not be a bad thing. And that investments in technology as banks move from a place-based business to a digital business is something that was going to be inevitable. And this might spur that along. Two, I'm not saying that the world that we live in now is going to continue to be the world that we live in the future. The world that we live in now is a world where the technology is changing rapidly and the regulation is changing slowly. That doesn't necessarily describe all states of the world. And so I want to be cognizant that the things that I'm talking about are really a product of what I see as about a 20-year period starting before the financial crisis and leading up to today, that has a unique sort of trajectory, both in terms of how quickly the tech is changing, but also how far behind the regulatory frameworks in at least some jurisdictions has become. I also get a lot of shtick for this. I'm not saying that banks are always bad at technology. I think a lot of banks, especially large banks that can deal with tech at scale, are actually quite good at technology, but that's not all banks. And insofar as only big banks get the good technology, there's actually implications from that we need to be aware of. That exacerbates the too big to fail problem, most importantly. I'm also not naive enough to think that more competition in payments is going to solve all the policy problems we have in payments. There are a lot of other issues that, you know, the public sector has to come to grips with in payments, in terms of access, in terms of the continued value and use of cash in various parts of the economy, and why having the option to continue to use cash is often valuable. There are also, and this varies by jurisdiction, issues around privacy and personal security that competition is unlikely to solve on its own, certainly. And last but not least, as somebody who lives in the world where most of my time is spent doing payment governance, I'm not saying that the type of more rich textured, multi-stakeholder model of payment governance that I'm advocating for is at all easy. The book talks about, and I have many more examples of failed experiments in the realm of payments that come down to politics, come down to the personal characteristics of the institutions and individuals that are in the room when it comes to making these choices. So that's that. Thank you for your time. I'm looking forward to hear what Kevin has to say, and then I'm looking forward to your questions and comments as well. So thanks.
Thank you. Kevin, do you want to share your presentation? If you want, you can raise your hand, or you can write a question in the chat or the Q&A. You can do it in Spanish if you want better, and I can translate the question. Okay. You're muted. Kevin, you're muted.
Yeah. No, so what I'll do is my slides are very specific. So when it comes to the slides, I'll pop them up if that's okay with you, Bernardo. Okay. So let me just start by saying that actually this is a very, I think, a very timely and very useful book. And I think it's not only lays out several complex issues in a very clear way. It's also very relevant for some of the policy discussions we're having now in Chile. And I think, I mean, the book has several insights, but probably at the key of these insights is this idea that money and payments are separate issues, and that money is related to the legal, supervisory, lender of last resort discussions, and payments is much more of a technological discussion. And you can potentially have different degrees of competition in both of these segments. So I think that's very useful for a lot of the discussions that are going on in this realm now. Just sort of interestingly, the way the book is written out, in particular, chapter 1, very much mirrors the way the Chilean Central Bank Charter is written up. Because the Central Bank Charter says really what the Chilean Central Bank has to do is look after the stability of money, which is basically monetary policy and inflation. And its second mandate is the normal functioning of the payment systems. And the way the central bank has interpreted this is basically bank stability and resilience on the one hand, and the payment rails on the other. So this actually sort of fits in surprisingly well to the way the book structures the payment discussion. So let me just put what is in the book in sort of the broad discussion of what's been happening in terms of payments in Chile, because I think it's interesting for the audience and hopefully also interesting for Dan. So we go back the last 20 years in Chile in payments. I think one of the first developments is that we had in the 90s a fairly large-scale development of credit cards from banks and non-bank credit card issuance. And I mentioned this because initially in the 90s until the late 90s, early 2000s, this is one of the ways that households that didn't have access to digital payments or to even a bank payment, access payments. And this grew very, very strongly and sort of then developed into, I guess, a fairly vigorous industry. And that's something fairly not typical in other countries. Obviously, there were banks issuing credit cards, but I think in Chile there was a development of the credit card industry, which already has a credit component, but also has a payment component. The second thing which happened in Chile was the fact that the state bank, Banco Estado, started issuing basically debit cards and light checking accounts in a very effective way. So we discussed with Dan before that Chile, we have the RUT, which is our unique tax ID. And what Banco Estado did was basically make it very easy for people to open a bank account with their RUT. And this really expanded the ownership of accounts in Chile and led to sort of a rapid growth in payments. So if we sort of look at what's been happening in payments in the last years, these two factors explain a lot. The third factor that is relevant to Chile is that there was fairly early adoption of a past payment structure. So this is something I just put here. You look at sort of which countries started with fast payment rails. Chile started in 2007, so it wasn't the first mover, but it was quite early. So what we had was the structure for credit cards, the state bank playing a big role, and fast payments technology being available from fairly early on. Because of this, because of several components, if we look at what was happening in 2021, a fairly high share of Chilean households either had a debit card or a credit card. This is data from 2021, but it sort of puts us somewhat below the OECD average, somewhat above what other emerging markets were doing. How have payments evolved in Chile? Just to get sort of a flavor of what's been happening. Sorry, these are in Spanish, Dan, but I think you should get the gist. We have a rapid growth in payments through debit cards, be it online or physically, and a fast growth of basically instant transfers. The graph at the right is actually a nice study the central bank put together, which actually shows what share of consumption is currently being paid by debit, credit, or what we call here prepayment cards. And that is actually probably the next innovation or the next stage in what Chile does. So we had credit, fast payments, the state bank, and in 2016, supported by the central bank and the bank supervisory, the authority, we passed a law which allowed basically for non-banks to issue sight deposits. And this has several of the characteristics that you were mentioning in the book. So their only function is payments. They have exclusive role in payments. They can't give out loans, for example. And they are restricted to basically short-term, high-quality assets. So something very much what the high-quality liquid assets would be in a Basel C structure. So it's not as narrow as your proposal, Dan, but it's fairly narrow. And these are what in this graph are these prepago, which are these non-bank debit card issuers. Let me skip the next slide. Because of this, this sort of I borrowed also from the central bank. The red boxes are these new debit non-bank account issuers. So the law was passed in 2016. The central bank and the supervisor took a year and a bit to bring out the secondary regulation. And once this took off, we had quite a fast entry of these new non-bank entities. So we actually have upwards of 10 of them now, and they're fairly active in payment, the payment space. So those. The other thing that's been happening in Chile, in addition to these non-bank account providers, is that we have a fairly active fintech sector. We have about 300 fintechs currently registered, and a large share of these are actors that are either issuing money along the lines that you were discussing, or providing a whole set of technologies around money, which is basically the technological area that you were mentioned. So that's somewhat where the setting is in what has been happening in Chile. In addition to these new account providers, the central bank has been moving forward to promote access and competition in the payments infrastructure. So on the one hand, in the credit market, which we didn't discuss in your presentation, it's been more explicit in terms of generating competition and the acquiring end of this market. There was a law that allowed for interchange fees. But I think more interestingly, from what you presented and the book, the central bank has now moved to regulating low-value payment infrastructure. So basically the clearing houses. And one of the key components of this regulation is that if you are a regulated entity, because you issue a debit card, or because you're a bank, you have access to this infrastructure. So it's open and non-discriminatory. And then, as we mentioned before the talk, very recently, in fact, a couple of years ago, the central bank also provided access to these clearing systems to their central bank accounts, and also to these non-bank deposit-taking entities to clear the money that is going through. So moving towards a more level playing field in that sense. I think the last chapter of what has been happening in Chile is the Chilean fintech law. The law has two big components. One is sort of regulating crowdfunding and other activities, which Chile had been somewhat slower than other countries in regulating. And the other is setting up a mandatory payment initiation structure, which draws from lessons in the UK and in Brazil, and forces banks and non-banks deposit institutions to provide APIs for payment initiation. It regulates these initiation entities, and the CMF, the supervisor, is currently sort of working and establishing a framework to make sure that this is efficient and robust. And I think this open finance, you mentioned it, is really interesting because what you're doing basically is building on the bank and non-bank money providers to actually complement technological capacities or services that they are offering with additional services that these payment initiators could provide. So I think it's sort of a third way of increasing competition. So let me just sort of finish with I think some of what the current key discussions are in Chile, and some of them are actually very much in line with what Dan was discussing. Interoperability of payment rails is a key component. Central bank has mentioned it, and I think your book actually is a good contribution to this discussion, because as you mentioned, it's obviously something you want to do, but I think it's something which is very challenging to do well. The second, which I think is interesting, is that although in Chile the central bank doesn't have an explicit development mandate, I think over recent years it has been incorporating a broader view of its role in the payment system. And I think this has come hand in hand with the fact that we recently changed the structure of supervision. We now have an integrated supervisor in Chile, and this supervisor does have a development mandate. So I think this has laid the space for a more constructive interaction in terms of developing or pushing the payment system, not only in terms of resilience, which was the central bank historic mandate, but also in terms of innovation and competition. And I think one of the pieces we're missing in Chile is how we institutionally not only bring together a central bank and the supervisor, but also involve the competition authority so that these three public institutions provide an interesting governance structure. And I think a third issue, which Chile has been an ongoing discussion, is if beyond requirements for free open access and free access for infrastructure, we need to move further, or we need to discuss also the property structure and the governance of the infrastructure. So is it enough just to set the rules of access, or do we need to go somewhere else? So those, I think, are several of the issues that are very related to the book, which I think are relevant issues in Chile now. And I think just two broad questions for Dan to get the discussion going here. I think first is we spent a lot of time in Chile trying to think about promoting competition in the credit card, debit card industry as obviously a form of credit, but also forms of payment. It's something you don't mention, so just to understand why you choose to leave it out of your discussion, because maybe there's an obvious reason. It wasn't so obvious for me, and I think the second big question is you highlighted itself. I mean, Chile has a relatively deep financial system, but I think we're still relatively far from saying we don't have financing gaps. There are segments, and in particular, I think segments for medium firms, which there are financing gaps. So I think the issue of disintermediation does come as a relevant issue. So just to get sort of some more thoughts on that issue, but I think at least from Chile, that is certainly an interesting perspective. And it actually sort of figures very explicitly when you look at the central bank documents and central bank digital currency. I think it's a concern that floats around. So again, Bernardo, thanks for the invite. It was a great pleasure to read the book. And Dan, thanks for a very insightful presentation and a book, I think, which is actually a very useful policy tool for thinking about several of these issues. It was a pleasure to read.
Thank you, Kevin. Do you want to respond immediately to Kevin, or would you rather, we don't have much time, or will you answer everything at once?
All I will say at this point is, one, I'm feeling the pangs of regret that I didn't look into what was happening in Chile earlier for the writing of the book. And then two, just because it involves plugging somebody else's book. The reason I didn't talk about credit was that my good friend Sean Venata was at the exact same time writing this wonderful book called Plastic Capitalism that is the history of the credit card. And I recommend it to absolutely everybody. It is truly a fantastic book. It's a history book, it's a policy book, but it's also a book about how it is we came about to have Visa and MasterCard as these basically technological behemoths at the heart of our payment system. So I'll stop there and we can open up to questions.
Yeah, so if you want, right, we don't have much time though, so I'm gonna read what it's already there, and I'm going to say a question in the meantime. So Ana Maria, who also works in this area, says, how to analyze the competition in payment methods without addressing the incentives banks have to offer the most profitable payment methods rather than those that are best for customers, right? And I have a question when I was reading, I was educating myself on your book. But I don't know if you heard the interview to Peter Thiel this week, who founded PayPal, and he kind of has like this thing of like, oh, we're not taking enough risks. So a part of me now wonders like, maybe we should. He will say just let the payment system take risks. That's an argument that a lot of people that work in innovation in fintech will say. What do you say to that? And also on the other side, I'm like thinking about Chile, like as Kevin explained, the government-owned bank increased the financial access to a lot of people, and also like the paying with cards was used to be a big monopoly. So I'm wondering on the other side, I'm like, maybe there is a way to do this kind of in a monopoly way, you expand like services and then you start competition. I don't know, what are your thoughts? So those three things, and we can close, I think, because we're on time.
Yeah, so those are all great questions. To Anna's question, most of the start of the book, and really most of my work, is about the incentives of banks and how that feeds into the type of payment systems that we get, in effect. So specifically, and forgive the very jurisdictional specific response. In the United States, one of the big reasons we have slow payment systems, ineffective payment systems, is that we have an enormous banking sector that is very heterogeneous. There are big banks. There are basically four big banks that have about 65–70% of the total payment processing, or are responsible for 65–70% of the total payment processing. But there's 9,400 banks. And so you get very different incentives at the top end of the market versus the bottom. And at the top end of the market, those big four banks are able to basically take your inbound payment and invest it in the repo market through their broker-dealer affiliates, and make a whole bunch of money over very large volumes and very small spreads. And so they don't really have much of an incentive at all to really create technologically advanced payment systems. Slow actually is a very big revenue generator for them. At the other end of the market, you then have very small banks that, quite frankly, do not have the capital base or human capital to be able to implement sort of technologically advanced payment systems. So I completely agree with you that the starting point for this is the incentives of the folks who we trust to design and build our payment systems in the private sector. That's going to lead me to the third of Bernardo's questions first, because of course this comes up against the fact that as a network good, payments sort of tend towards monopoly. And if I had a benign monopolist, it would almost probably be the best situation there, at least in a static sense. But the problem is that technology is dynamic. And if I have a monopolist who is not subject to any market contestability, I would expect then them to fall behind the technological frontier. And so if you look at my list of good payments policy issues, even if there aren't actual competitors at any given moment in time who can viably compete with a monopolist, I want the market to be as contestable as possible. I want there to be as few legal barriers to competition emerging one day, and that contestability actually provides a set of incentives to the monopolist to provide or at least invest in new technology in ways that benefit the consumer. And I think that's a truly important point. I've done work with Josh Macy at Yale, where we look at this in the context of securities clearing and settlement, where we have a monopolist in the United States, the DTCC, and our sort of argument there is that, and it's an interesting example because it's a world where there actually is an interoperability rule. It's just that the way it's designed led to the DTCC's monopoly, because they already had scale, and scale enabled them to actually say, we're gonna have great technology, and all of you small players are just gonna have to become interoperable with us. And that killed them within the first generation of the interoperability's rule existence. And so we use that example then both as a way to understand the policy goal and rationale for contestability, even in a monopoly situation, but also that it's easier said than done, because in theory, interoperability rules can help create the contestability, but if you design them wrong, they can easily have unintended consequences and actually do the reverse of the thing that they otherwise were supposed to do. Which then leaves me with the Peter Thiel, Ross Duhat interview. I was stuck at an airport most of yesterday afternoon, so I popped on an hour with Peter Thiel. I will be the first person to say that in general, I find 95% of the things that Peter has to say are kind of, pardon my French, but batshit crazy. But that's his role in society, is that there's very little about him that is conventional at all. But I did note the same thing that you noted. And this is something that I have long stood in the middle of. Silicon Valley, the tech side, the payment side, is move fast and break things. The Fed side, the monetary side, is move slow and, my God, don't break anything. And it's kind of the collision of those two worlds that the book is trying to address. When I'm dealing with technologists, they really have very little understanding of the core ethos of the regulators in this space. When I'm dealing with regulators, very few of them have a set of incentives or a skill set necessary to truly understand the technological decisions that, in effect, their policies are making. And they are making policy around technology, right? Even if your policy is to not let new players in, that's a choice about the technologies that you're willing to sort of subsidize or not subsidize. And so I did make note of that. And I do think that this is another way of looking at the core issue here, ultimately. And I think my solution is attentive to that. Why? Because money is a place where we cannot move fast and break things. Society breaks down if you go down this path. If you create good money, you can have the forces of unconstrained competition in payments. Why? Because the worst that happens is that somebody looks at their Wizzy app and they're like, actually, this thing ain't that Wizzy. I'm going to transfer my money back to my bank. As long as I can keep the money safe, the technological experiments, the move fast and break things, can't break that many things, ultimately. And so I think, while no system is perfect in this regard, I think that Peter has his pulse on this particular issue, or at least one half of it. Coming from the tech side, it is about the forces of competition. Where I would add to what Peter said is that only on the tech side, not on the side when it comes to the design of your monetary institutions.
Okay, yeah, I agree. I had the same impression of the interview, and that's a very good way to put it. So thank you so much. This was great. I hope to see you everyone again, and maybe we'll invite you to the next book in the series.
Yes, by all means, please do. I would absolutely love to be a fly on the wall. And thanks again to Kevin. I have 1,000 notes, and I suspect at least 3 or 4 of those notes will end up in your email inbox, just with questions about sort of the political drivers of the situation in Chile, because it does seem like you've thought as a country more intently about this than a lot of the jurisdictions I've dealt with. And then 2, whether the business models for non-bank payments in particular, how they've been working out, what the business models are based on, and whether those firms are thriving economically in addition to providing sort of, first-class tech for payments.
Okay, we'll talk. Okay, great. Thank you. Bye. Thank you, everyone.
Bye.
Bye. Take care.